No, John Bollinger didn't invent Bollinger Bands. He just put his name on it. It's like if I took moving averages and started calling them Courtney averages. It'd be like that. You know what I'm saying? Anyway, hey, let's get right into this market. Let me give you some advanced analysis here. What we see here is this is the S&P going back 3 years. And I have put Bollinger Bands, so-called Bollinger Bands, which are just standard deviation bands, around the price action. Let's take a look at what happens when the price breaks the bands. Now, you can see that happen. Last week, I came in here and said I didn't think we'd break the lower end of the bands, and we did this week. So let's take a look and see, does this mean something? Well, if we go all the way back to the far left-hand side, you can see we broke it to the downside, but there was no continuation at all. That was the end of the drop. Then we go to the right, and we see the green arrow where it broke above the top of the range, and that was the beginning of a large bull market, although you'll notice that for 6 months after that, the price went down. We go over a little bit further, we see another green arrow. Once again, could be considered the beginning of a pretty strong bull market, although it did go sideways for 5 or 6 weeks after that. Then we go over to late 2017. This one just broke out and was definitely the beginning of a very sharp move up to the high that we made in early 2018, which is really the next time we broke out of the upper part of the band. And you can see that once again, it completely failed to continue to move higher. It really defined the top of the move. Then, about 2 months ago, we just barely snuck above, and that was also really the end of the move. So as you can see, when we break above or below the bands, it doesn't mean a lot. Sometimes it could mean an acceleration of the trend and that we're now in a new bear market. But most of the time, when it gets above or below the bands, that's usually the end of that move. It doesn't usually break through. It usually stops before it breaks through. But even when it breaks through, it's usually the end of that move. In other words, this dip that we're seeing right now, that's the end of the drop. Now, let me give you another piece of evidence. This is the daily S&P. Which you all recognize, but superimposed over it is the regular old RSI. And I want to show you a couple of things that you can see why I use this technique. But notice that at the end of August, we made a new high in the S&P, and we made a new high in the RSI. We then, in September, made a new high, in fact, the all-time high on the S&P, but the RSI did not. That's called divergence, momentum divergence, and the market collapsed. Well, now we're seeing the exact opposite. The market plunges down. We see the low in the RSI. The market comes and makes a new low, but the RSI does not. This is momentum divergence and tells us that the market is about to move higher. Hey everybody, Courtney Smith here for October 29th, our Wall Street winners. Let's keep on moving here, okay? Well, this is fantastic, but we'll just move quickly through it. So the one thing that is bearish here in this market is the purple predictor. The purple predictor showed a little bit of stability, but if you look very closely, it made a lower low on Friday and the price didn't. In other words, the divergence was actually negative here, unlike the RSI, which was very positive. It's just a little divergence, but nonetheless, it makes me nervous, and the purple predictor remains bearish for the market. Looking in the upper right-hand column, notice that the red line showing selling pressure is pretty stable. But the green line shows buying pressure, and there is no buying pressure. It's going down towards zero. That's still bearish. In the main chart itself, we broke a trend line here, although I don't count trend lines as being very valuable. In the NASDAQ, this one's a little more interesting. Notice how the purple predictor is actually a little bit bullish now. In other words, the purple predictor is above the price action, rather than being on or below the price action. That shows that as the market was being sold off, the smart money didn't sell it off. So it could be that the big broad market, as represented by the S&P, still has some selling to go. But the leader to the downside was the NASDAQ. That was the one that got hit the hardest, and it looks like people are coming back and maybe buying here at these cheap prices. Seasonality remains on a neutral signal, so nothing going there. I'm going to go to the second chart. Notice the sharp dip that's supposed to occur in late October. We just got that. Then what's supposed to happen is in this here at the end of October into the early part of November, we're supposed to get a sharp rally, then another dip in November, and then pretty much clear sailing till the end of the year. I think that's exactly what's going to happen. I think when I put it all together, I'm looking for this market to rebound this week. But it won't look like the bull market's back again. We'll move down again in November, then we'll start to move higher. The yield curve, the yellow line, you can see we're about to go into a period where the yield curve gets much flatter. That's going to keep a cap on the market. This is going to stop us from really making new all-time highs, I think, before the end of the year. I don't think that's going to happen. But notice, in early 2018, the yield curve widened out a bit. So to me, still looks like the first quarter is going to be very good. But look over in the right-hand column. The red arrows pointing to the fact that our yield curve has started to narrow again a lot. It's come down a lot. We're not quite down to where we were in August, but we're down a lot. It's not to the level that causes crashes. It's not even close. But as it gets closer and closer, the pressure mounts. Asset allocation, again, they're trying to get out of stocks. They're getting out of stocks. Well, you can see it because the market's down. That's pretty obvious. The risk indicator, we got a little rebound late in the week, but boy, market participants are saying, I got to get out of this thing. If I'm going to buy stocks, I'm going to buy really low risk stocks, utilities, boring old food companies, the usual safe havens. Global shares, I haven't been interested in them in a long time. And as you can see, they're way worse off than the US market. Bonds, this is where the money's going to. We talked about asset allocation. So what they've been doing is that they've been selling stocks, they've been buying boring safe haven stocks, and they've been buying bonds. Now, this is very important because what it's saying is that if these bonds continue to go up, that means that long-term interest rates are going down. And that's going to be one of the reasons why we're going to see the stock market pop this week. In addition, what's happening is we're hearing more and more talk that the Fed should slow down their tightening, and including a Fed governor, I should say, came out and said, no, let's slow it down. Well, that's a person that has some pull. You and I, we don't have any pull, but that guy has some pull. So we're starting to hear the market have the concept that the Fed is not going to raise interest rates as quickly as they have previously said, and that's going to help the stock market out this week as well. Bond key factors, this is really quite interesting. So the green line shows that we've got this little hook down in interest rates. The CRB is pointing to lower interest rates. The 10-year Treasury in Germany is pointing to lower interest rates, and only gold is pointing to higher interest rates. So net, we should probably look for lower long-term interest rates this week. The dollar, it had a nice rally. We talked a little bit about this last week. I'm really not that interested in the dollar right now. Gold is where I've talked about a little bit more. So as I said before, you should be long gold right now because of the breakout that we had back here. We talked about that here on Wall Street Winners. I think we're just going to be in a grinding bull market. There's no reason to really look for an explosive bull market. So why is it going up? You can see it's indicator number 3 here, which is the Japanese yen, which has really exploded to the upside, and that's what's causing this gold rally. You can see the CRB is a little bit negative, Euro US a little bit negative. Oil coming down. Now, as you know, I turned a little bit more bearish lately, and I'm actually doing this broadcast from the Middle East. I'm in Dubai right now, and so I've had an opportunity to really get into the talk, shall I say, from meeting people in the oil industry. And, they're saying that there's going to be more oil pumped out here. So from a fundamental perspective, it looks like oil will continue lower. I'm just worried that there's not a lot of downside potential with all the technical support under the market. All right, no update today on Bitcoin. Let's just carry on. Upcoming events, November 11th and 12th, Option Success School. I'm here in Dubai for a course. We just finished it. Had a great time, great people here. Beautiful, unbelievable, beautiful city, all brand new, shiny, with maybe the best modern architecture in the world is here in Dubai. It's really incredible. Coming up in January, I'll be back here in Dubai with our Extreme Profits course. Now, we will be putting up a whole bunch of new courses here very, very soon. And also make sure you've read this. All right, Stock Butler, that's where we get the stock ideas for our fully paid up members section. All right, that's enough advertising. That's it for me for this week. For freebies, all you fully paid up members, you're very, very special, of course. So hang on just a moment.